There are two philosophies of investing in fixed income. One is income maximization, where the investor buys the cheapest thing in the market at any point in time. The second is total return investing, where the investor looks not only for relative value within the market at a point in time, but also within that security's historical context. I'm Chris Ryon. I'm one of the co-managers of City Different Investments fixed income team. There are three components that derive a investment's total return. First is the income, okay, pretty significant. Second is the security's price return over a period of the investment universe. Third is the interest on interest portion of total return. Each of these elements varies with the maturity of the security and the holding period of the investment. So think about it this way. For a one-year security, the biggest portion of total return is going to be derived from income. As you get longer on the maturity spectrum, the combination of income and price return are going to be the major contributors to total return. Finally, if your investment horizon is, say, 1 year, you're really not going to care about interest on interest. But if your investment horizon is 7 years, then interest on interest will be the major driver of total return. That's compound interest. Now let's look at an investment within its historical context. Perfect example right now in the treasury market. The yield curve is very flat. Right now an investor can pick the spread between 2 years and 10-year security is 50 basis points. So a 10-year security is cheaper than a 2-year security. But on a long-term basis, the average spread from 2s to 10s is 100 basis points. So we would argue that the 10-year security is overvalued compared to the 2-year security. Another example, let's look at a 5-year security versus a 10-year security. We're using these examples because we take the whole credit spread portion of return out of the equation. Right now, a 5-year security, treasury security, earns 90% of a 10-year security's yield for only 50% of the duration. That's the value. The long-term average is 77%. So again, another example of how a 10-year treasury security is overvalued compared to a 5-year treasury security. A total return within the context of how CDI manages fixed income. We manage our fixed income portfolios through an actively managed laddered portfolio. Our research indicates that over the long run, a laddered portfolio will outperform the other two structures, that being a barbell, where an investor invests in the extremes of their investment universe, short and long, or a bulleted portfolio, where they invest in the middle of their investment universe. A laddered portfolio is going to protect an investor from asymmetrical yield curve shifts. And we think it will give an investor the best risk-adjusted total returns over time. Now, I said we were actively managed laddered portfolios. In the example I used about a 5-year security, what that means to an investor in our separately managed accounts is that you'll find we have overweighted the 1 to 5 year because of that value mismatch and underweighted the 6 to 10 year portion of those investments. So in short, that's why we are total return managers versus income maximizers. Thanks.